Well, short-term upside exhaustion, finally. So after such an impressive relief rally off of the December low, we do have some signs of exhaustion from an overbought, oversold standpoint. Those tend to matter when you see a downtick in momentum, which is indeed what we could be seeing even today. And I think it increases risk, not necessarily of a retest of the December low, but certainly some kind of higher low on a relative basis.
You brought a chart along showing us sell signals. Can you walk us through? We're going to put it up here.
This is a generic chart of the S&P futures, and we do have a sell signal, the likes of which we have not seen since September 21st, which was actually the day of the peak. So I'm not making such a major bearish call, but the bearish bias is still there from Q4 and the loss of momentum that we saw then. Prior to that, we had another sell signal in June that yielded about a 2 to 3 week pullback. So at a minimum, I think that's what we should expect.
What makes you think that if we do get another pullback, it only stops out at a higher low rather than retesting the December lows?
It's really the improved intermediate term momentum that we've seen with the relief rally because it has been so impressive. Our intermediate term gauges have actually flashed buy signals, not strong buy signals, but they're there. So it really did improve the outlook.
What did it flash in December?
It was a major long-term sell signal in October based on a monthly trend falling gauge.
In October, though?
One. In October. Yeah, we should have all listened to that one.
Yeah, really.
Well, I think talking about September as a portfolio manager gives you the chills. You know, like that's just bad situation. But I think one thing that is different in January or February is the fact that the Fed is at a different point. Does that change the downside in your view?
Well, really, any relief of uncertainty makes it better, right? A more conducive environment to improve momentum. So I'm just a technician, so what I see, of course, is improved momentum that could suggest a higher low. And I think that's what we look for, as sort of a bottoming process, not a V-bottom. That's very rare. We do often get some kind of retest, but position for that short-term downside and then look for opportunities. I do think that we'll see a little rotation or additional rotation from growth into value. So that's a shift that we're starting to see more of, certainly on the small cap front. I think there's risk of that too.
I think a short-term correction in and of itself perhaps is not a bad thing because at least it keeps the Fed at bay. Because if the markets just keeps going up, it brings the Fed back into play, and you don't really want that.
Krishna, when you look at the U.S. equities, how are you thinking about the broader valuations? Given the change in Fed, is a 16, 17 now more justified times multiple?
Yeah, so our point with respect to U.S. markets is it's really not earnings growth that you're looking for. Earnings are going to be really under pressure. It's the fact that the Fed is is supporting the market, providing the tailwinds as opposed to providing the headwinds, and that makes a great deal of difference. The risk premium goes away.
What levels next are you watching in the S&P?
Resistance, of course, the 200-day moving average is in play, and sort of 2,800 is a natural resistance level for it. We have to look at these as not precise points, but cushions, and in the same way that the 200-day was a cushion for support, now it's a cushion as resistance. And then as support on the downside, about 2570 to down to 2550 is initial support, and therein lies the risk.
Katie, do international equities have a similar setup to this, i.e. starting to find some resistance, but it shouldn't retest December lows?
They do. I'd say the pullback should be broad-based globally. Even emerging markets, which have gained relative strength, as you know, the dollar is poised for a little oversold bounce that may damage the momentum there as well over the short term. But the setup is very, very similar in Europe and beyond.
We've also been talking about this regional bank merger this morning, and that's an index, the regional bank index, the S&P regional bank index, that's up 15% this year. So, I mean, of course, the last part of the year was terrible for this index. But what do you see there?
Well, if you look at something like KRE, which is an ETF that represents that sector, it has the same sell signal, but I would say it's a bit worse because it's more of a pronounced downtrend that preceded it. So it's really a year-long downtrend in the regional banks. And with a short-term overbought sell signal within that framework, it does increase risk. But there, too, we have seen those intermediate-term buy signals that suggest we'll get some kind of bottoming process on back of this.
So let's assume for a second that we actually do see that correction. From a medium-term perspective, based on your technical analysis, is it a buying opportunity or is it a selling opportunity?
What we want to see on that so-called retest or corrective phase are positive divergences, so less downside momentum than we saw into that December low. I don't think that would be hard to do because obviously that was very strong downside momentum. So with those positive divergences, and then once we actually get a little stabilization that improves the short-term gauges, I think we do look for buying opportunities.
Fantastic.
In terms of thinking about where we were December 24th, is it a lot of people say, oh, we have to retest those lows. It sounds like you don't think that necessarily has to happen.
Not anymore, not with the improved intermediate term
Okay.
momentum. However, the retest is very common. It's very standard. I think this environment is very much like 2015-16, where short-term volatility is going to be heightened, and yet it's not a 2008.